man, this is it, guys. This is it. The moment we have all been waiting for, the FOMC meeting, which can finally give us a pause. Guys, if you're expecting a pause today, smash up the likes. If those of you who've been joining us since the start of this rate hiking cycle, it's been a long, hard, painful slog, but today the market is all in. They are expecting a pause. 99%, this is as certain as you get, guys, are expecting a pause here in this market. Will we get this pause? Now, I do have a few warnings. I do have a few caveats. We have the announcement in 10 minutes. Then half an hour later, we will stay on the live stream. You will have Jerome Powell's press conference. There's two elements to this, and we've got to pay attention to that as well. There's also something called the summary of economic projections, but we'll worry about that when it comes out too. This market is expecting a pause, and that comes with a bit of a worry point, because when there's an expectation, there is the possibility of a rug pull, and Jerome Powell is in control of that right now. Jerome Powell goes into this meeting and he has known over the last week or so that this market is expecting a pause. By the way, guys, let me know if the volume is okay. I've got the fan blowing because it's really hot in here. Is it affecting the audio? Let me know in the comments, guys, and I'll get that sorted out for you guys by suffering and sweating instead. But where there's an expectation, there could be a rug pull. And Jerome Powell today, if he wanted to, could deliver a rug pull. Now, I don't feel like he has any reason to do that. I feel like he could come out and comfortably deliver a pause. The majority of the market are not expecting this just to be the final pause, right? If you take a look here at the probabilities, 97%, 90% pricing in a pause today, fine. Then they expect one more rate hike at the next meeting on the 26th of July. Then they expect us to stay there to the end of the year, because obviously Jerome Powell said there's not going to be any cuts this year. And then they start seeing us cutting throughout 2024, bringing us back down below 4% by the end of 2024. Okay, so that's where the market has this currently. But are we going to get rug pulled? That's going to be the main situation right now. Now, let's take a look quickly here at what some of the major outlets are expecting. Bank of America expecting a pause, Barclays pause, Citibank, the only one here on this list, expecting rate hike to come in. Remember, CPI came dramatically to the downside. PPI earlier today, in between my videos, came in to the downside as well. Let me just show you what the producer prices look like. Let me just click on producer prices. We'll go into prices, and we're going to look for the producer prices change, and you're going to see that came in at 1.1% versus the consensus estimate of 1.5. So nice big drop of 1.2% here on those figures. Guys, smash up the likes if you're expecting a pause, a pause, a pause, a pause. Are you expecting that? Do you think the market is going to rally? Because every time we've seen a pause, and I've managed to dig out this chart for you guys as well, which is a research based on the S&P, and the S&P is asking, let me just turn this up, see if this helps. Can you still hear me okay? Hopefully this all speeds up okay, and I'm not overburdening this machine with everything that I've got going on here. Turn up the fan speed. Cool. Okay, so that should be all good. Let me know if it causes any problems on the lag. But every time you look at this, the S&P has always gone up after the pause. So if you call this 0 the pause, and you count up 100 days thereafter the pause, every time there's been a major rate hiking cycle, we've seen relief. Now, what makes this important is that this is a major rate hiking cycle. It's the steepest one we've ever had. So in this market, will be desperate for a pause. However, they don't expect it to be the ultimate pause. They think there's one more thereafter. But it's a good sign. It's a good sign that inflation is coming down. It's a good sign that things are starting to improve, and that's ultimately what the market wants. Remember, the pause marks the moment where the Fed is now neutral, right? I always use this analogy of the Fed either being your friend or not being your friend. When they're your friend, they're putting money into the economy. When they're not your friend, they're hoovering money out. And for the last year plus, they've been hoovering money out of this economy, right? Now we need to look to the point, can we be neutral, so at least they're not hoovering money out? And then one day we get to sunny pastures again where they're releasing money into the market. Now, of course, with crypto, we still know we've got loads hanging over our head still. So the question is going to be, if there is euphoria, can crypto benefit? Right, we're going to monitor the Nasdaq on the right hand side here. This is a minute chart, and on the left hand side we're going to have the Bitcoin versus the dollar, right, on the left hand side, and we want to see now what's going on. So straight away here you're seeing excitement rallying into the announcement. The first yellow line is the announcement we get in 6 minutes time, and the second yellow line on this chart is going to be when the press conference starts. Now, just quickly, we've got 6 minutes to go. I need to make sure everybody understands we're going to get a decision whether he pauses or not. if we pause, the market has priced that in. I don't expect there to be crazy room for moving. I think we will see some happiness in the market. I think we'll see some buoyancy. I don't expect a crazy move, right? Because the market was already expecting it. Now, what could upset the market is the rug pull. That rug pull is so skewed to the downside that is what I'm actually worried about here, is a rug pull. Now, what could, this is what you want to look out for, and we'll do this together as we're going through it. What could skyrocket this market is pausing, followed by Jerome Powell hinting a clue at what could come at the next meeting, right? Because the next meeting, they're pricing in a rate hike, and if he says, no, we're going to pause for a couple of months now, that could lead to the market moving. Because the market has gone, hang on, we're going to pause now, and then we're going to have another rate hike in July. So that's what we're looking out for. Now be very, very careful on these minute charts. The traders are going to play a lot of games, guys. If you've done a couple of these with us and you watched a few of these, traders play games. If you're experienced and you want to trade the volatility, ijaz.uk/Bybit. If you're not experienced, you want to play around with some lunch money, you can do so also. When you do deposit on Bybit, which supports the channel, you also get some amazing bonuses. So you can trade with just the bonus that they're giving you, and you don't even need to touch any of your money. Definitely practice around. These are the best times to trade, is when you've got an event, you've got volatility. The best traders in the world wait for a forced event like this, where huge amounts of volume are coming into the market, and then they trade. And if you can become experienced doing so, you can catch some crazy moves there. Cool. Smash the likes if you are looking for a pause today. Apparently only 30 of you are looking for a pause. And let's just make sure we got our TV working. I've managed to set up a TV for you guys, because I'm a great host. Let's check that the volume's working on this TV. Give me a shout in the comments if this is working okay.
Heavily into R&D.
Big company like Samsung and LG, lots of interest in collaboration with the startup.
The whole genre of K-drama, you're just simply spoiled for choices.
For studios, it is an advantage to have a diverse distribution channels, so we will continue to diversify platform.
We've found time after time that when a show is loved by a Korean audience, it has a very, very high likelihood of being loved by the audiences around the world.
Okay, great stuff. So that's working. Now, some people are making the argument that we could just expect to pause. We could just do the 25 basis points, right? Just do it. Get the rate hiking cycle done, bring inflation down to 2%, and then pause when you're done. But others are arguing, what if you drive us into a recession? That's going to be the key battle right now, is you don't want to over-egg this and therefore mess up the economy by driving it into a recession. That's going to be the key battle going on. So let's jump back into the TV. We've got 3 minutes to go.
NASDAQ with another gain, now up 30% so far this year. So let's bring in our panel. Julie Beal, portfolio manager at Kane Anderson Rudnick. Michael Kushma, CIO of Global Fixed Income at Morgan Stanley Investment Management. Greg Ip, Chief Economics Commentator at the Wall Street Journal. Welcome to all of you. Greg, let me start with you since you're sitting right on my right hand here. You think that the Fed could actually raise rates even more without damaging the economy. Is that what you favor them doing?
Well, if you look at the current configuration of rates and what the economy is doing, it's hard to make the case that they've managed to accomplish a lot. Inflation, core inflation seems very sort of sticky around the 4 to 5% area. The economy seems to be doing just fine, very strong job growth. And look, the stock market is up 22%. Like in my book, that is not the sign of a market that's worried about like a really vice-like grip coming from the Fed.
And you look at the regular CPI, including energy, and you look at energy, and it was one of the main reasons that number came down as much as it did.
Right. So I think people might be getting a bit of a head fake. It's great that the overall inflation rate's down from 9 to 4%, but we know from years of covering this that the underlying trend is better arrived at by getting rid of the food and energy components. That gives you 5%. Now, take out some of the other stuff that's a little funky, like shelter, cars, and so forth. You end up with something that's we're calling supercore, and that's like running at 4 or 5%. And none of those numbers are anywhere remotely close to what the Fed wants, 2%. So that's why I think that there's a bit of a reality check in order.
Michael Kushma, give us your setup here with 2 minutes to go, quickly.
Sure, I think there's a good case. I think 60-40 that they pause or.
He's only 60-40, guys. Markets are 98% certain. Give me in your comments, what are you expecting? Pause or rug? Type pause or rug. If we get rug, guys, it's going to be nasty. Hopefully, we just get this pause. We move on to the press conference and see what happens.
Come down a lot, as Greg said. But on the other hand, major components of it are not decelerating very fast. And if you compare today's data with what they were projecting back in March, the last time they put together their projections, inflation's higher than expected, unemployment's lower than expected, growth is stronger than expected. So from most perspectives, you would say their job is not done, but we're getting close.
Julie, let me ask you, as if this is a castle built on sand, as we emphasize the strength of the market, we're also approaching, the 15% post-inversion rally everyone said we should expect. So do we have this run its course and then revert to the bear market as the economy slows?
I think it's going to actually be sector specific. I think there are already pockets of the S&P that are in a clear earnings decline, where margins have been super pressured by not just overall commodity price increases, but wages as well. And so it hasn't really rippled throughout the economy, but I think there's going to continue to be these uneven sections. So unlike most recessions where we kind of...
All right, guys, let me refresh now to see if we get it up. It's on the hour on my clock now, so I'll start refreshing. And let's see when they put this up. Okay, it's up. Let's take a look. The PDF. Let's take a look. It's always nerve-wracking. Let's take a look. Where are we going? 5. Yeah, they paused, guys. They paused. We've got a pause. Good stuff. Off we go with a pause. Let me just show this to you on the screen here. We have a pause. Let's jump on over to the chart, see how markets are reacting. Let's see what traders are doing. And you got a fall on the Nasdaq and a move on Bitcoin. Very interesting. This is just the trading chart just now. Okay, Bitcoin's catching up to the downside. Very interesting. See, as I told you guys, markets are pricing this in. So let's take a look at the other details why that's falling to the downside. Let's see what they've said. So we've got the pause there. The TV is behind, so we'll ignore the TV there for what they're doing. And let's see if we can get, let's see, he's coming in now.
Rate of the funds rate to 5.6%, indicating a very hawkish committee outlook and strong support for at least 2 more rate hikes this year. I think this comes under the definition of a hawkish pause, maybe a very hawkish pause.
That's right.
FOMC statement saying it's holding the target rate steady, allowing it to assess additional information, including the cumulative effects of tightening and lags of monetary policy. I want to go through in detail here the summary of economic projections and the funds rate. Only 2 members of the committee are forecasting the rate at the current rate of 5.13%. 4 support 1 more hike.
This is why they're upset, guys.
Half of
See
the
this? I'm going to explain this.
is forecasting 2 more hikes, but there's more because 2 are supporting 3 hikes and 1 supports a full percentage point higher.
Okay, that's why markets are not happy. Very important to understand this, guys.
Funds rate. The committee sees more inflation this year than it previously did, forecasting a 3.9% core rate versus 3.
Okay, so let me just get into this, guys. So what you want to look at, this is the summary of economic projections, which doesn't come with every FOMC meeting. Now, as you can see, for the end of 2023, they've upped this from 5.1 in their last SCPE to 5.6. Now, what that means, therefore, if we're at 5 right now, that means to get to 5.6 as the lower band. That's another 225 basis points rate hike at least, on average, right? That's how it works. So what they've basically done is they've notched this up by 2 more hikes, which the market hasn't got priced in. The market had priced in 1, right? If I come into here, you can see that the market priced this hike to come into here, and then they expect us to start cutting all the way down. Okay, but they have not priced us to go into this region between 5 and 5.75, 5.5 and 5.75. So that is where we're starting to get a bit of incongruency here, which is why you're seeing the markets fall. This is classic Fed. It's a hawkish pause because they don't want the market to run. They want to pause to see what damage they've done, right? They want to pause for a month to see what damage they've done. But at the same time, they're saying, no, we're going to keep our noose around their necks because we can't let them get too excited just yet. Also, take a look at the unemployment. They've notched the unemployment down slightly for this year because they can't get unemployment up to 4.5% this year. They've not managed to dent the labor market. So they've not shut down, say, oh, we'll probably get to 4.1. I think they're about 3.7 right now. They've revised GDP up, which basically is them saying, oh, look, we're not going to have a recession this year in 2023. We're going to kick the can down the road. Maybe we'll get one next year or in the mid of next year. So that's where we're sat on the summary of economic projections. Let's also see, did we get the dot plot? And this is where you can start to see that you've got a few people now sitting in this camp, right? You've quite a few people sitting in this 5.5 to 5.75 camp, which we didn't have priced in, right? The majority of the members here, think of these as all the FOMC members, which it is. They're sat at the end of 2023 here. This is 2023, this set of dots. They're sat here at 5.5 to 5.75. And you've got 3 members who want to go even higher than that. So you've got the vast majority here, if you add up all these dots and these 3 above it, suggesting we're going to be higher than 5.5, which means more than 1 rate hike from now towards the end of this year. Okay, so this is a hawkish pause. Let's go over to the TV to see what they say. And then we've got Jerome Powell in the next 20 or so minutes coming in for his press conference.
They are cracked up to be A. B, I think a lot of the used car prices are stale. everything I'm seeing starting to come through looks a lot different. And I think when you go to July 12th and you see the June CPI report, you're going to see a significant ding from used car prices, exactly the opposite of the last report. That's not all. Let's think about the trim mean, the 16% trim mean put out by the Cleveland Fed. If you look at that, and of course that's ex food, energy, and used car prices, what you see is on the quarter-over-quarter annualized, it's now under 3%. So I think there are a lot of reasons to be nervous if you look at more stale data and you assume that these numbers are going to perpetuate themselves. But I think the reason equities were so strong yesterday is some of the traders have looked through the numbers and are trying to look towards the next several reports. And I think the future they see is different than the past.
All right, let's go to Bob Pisani for a quick update on where the stock market stands right now. It looked like it started to nosedive immediately.
Yes, but only about 25 points in the S&P. That is not a huge move. So remember last time we had a dovish hike, and this time we get a hawkish pause. I'm not sure this necessarily changes a lot. Certainly, you got half the committee supporting 2 more rate hikes. I think that's a lot more hawkish than equity traders anticipated. But I'm not sure it dramatically changes the situation. What we've seen here is the S&P right now is trading at nearly 19 times forward earnings. That is not only not a recessionary multiple, that is an expansionary multiple, and 25 or 30 points on the S&P isn't going to appreciably change that. The problem right now, and maybe this is a good pause right now, is the S&P and the markets are really pushing the limits of the soft landing story. We've moved up 5% just this month because the jobs report is so strong, the numbers are so strong, and the belief is the Fed is near done. I'm not sure 1 or 2 more points or 50 more basis points really makes a difference. So here's the hope for people wanting the market to move forward at this point. The volumes have been terrible recently. A lot of people still don't believe this soft landing story. And all of those people who bought treasuries, 1-year treasuries 3 months ago at 4.5%, the S&P is up 13% since that happened in the middle of March. And the question is, regardless of whether we get a 25-point drop in the S&P right now, which we just got, whether or not those people are going to get any kind of FOMO and believe that the economy is going to remain relatively strong. There's your hope for the market to move up right now.
Incredible reactions here. Dow's down 334 points. Greg, do you think this is them putting the knife in the soft landing story?
Not really. I was just actually looking over the numbers here, and actually, if you take the numbers at face value, they almost sort of strengthen the soft landing story. They've got GDP growth up more this year, like I think around 1% versus 0.4%. Tiny little trims to it next year and the year after that. Unemployment rate lower over the forecast horizon. So actually, if I look at the unemployment and GDP forecast, the Fed seems more comfortable with the soft landing story. The weird thing is, but they have that against a world of higher inflation. So in some sense, they're saying, we think we can still get the soft landing, but given that inflation...
Okay, guys, just catching you up for those who have joined late. Yes, it was a pause, but there was a hidden rug pull, exactly what we expected. The Jerome Powell has come out with a hawkish pause here to be aggressive on the market, and he's done that by saying, yeah, we're going to pause, but that where you were expecting that, you know, we were only going to have 1 more rate hike, we're going to price in a couple just to throw a curveball at you guys. So now we're going to switch to the press conference, which is going to come up shortly, and I think he's going to do more of the same. I think he's going to double down on that tactic to say, you know what, we're going to pause, we're going to give them from one hand, we're going to slap them from the other hand to say that we're still going to keep rate hiking. We don't want them to lose focus on the 2% inflation work. The job isn't done, right? Because the last thing he wants is for the market to now rally over the next couple of months, go crazy, loosen financial conditions, and then inflation end up rearing its head back up again and going back up to 4.5%, right? He's done his hard work to get to 4%. He needs the next reading to come in at 3.8, 3.7 to keep it moving to the downside. So that's where we're sat. So we will head over to the press conference shortly. This is why the market is falling, and this is why you've got to be very, very careful with these guys. There's a lot going into each and every one of these meetings, and if you're not clued up on the macroeconomics, you're going to get thrown for a curveball. Particularly, I find that a lot of people who invest in crypto struggle to follow this stuff. I'm lucky enough that from TradFi we used to monitor this stuff regularly, but it's not easy. There's so much that go into it, the dot plots, the summary of economic projections. If you missed my explanation, scroll back to about the 12-minute mark. I think the 10-minute mark on the clip will be when the decision came out, and then about the 12-minute mark I was explaining exactly what happened and going into the document. So do scroll back if you missed that. Guys, smash the like so if you enjoy this stream, if you appreciate the breakdown here. And we'll just take a look here at the charts. If you guys have any questions as well, feel free to ask me any questions. And as and when I get a pause, just like the Fed paused, I'll go over to your questions to answer them. Planet Positive asking, will the bull run start now? Absolutely not. Absolutely not. Not just yet. We've got work to do. And you can see the markets are tumbling here a little bit on the news. Not too happy with the hawkishness. Jay Haight said there's more rugs in carpet world. Yeah, look, it's not an ultimate rug. I mean, the worst rug would have been if he just didn't do the pause, right, and said we're going to keep hiking. But it is smart how he did it, right? He gave with one hand and he took with the other. He's given the pause, but he didn't let it just be, oh, we're letting the dog off its leash and off you go. No, we're going to keep pulling on it just to make sure the market doesn't get too excited. Cool. Let's see what else he's saying. I like this guy.
And what I want to do now is I want to do a visual demonstration of the precise way that Rick just described how Fed is making policy. They are driving looking like this. They're looking in the back, but they're driving forward. That's exactly what Rick is describing. I was hopeful that the Fed was going to take a flyer on making policy on the forecast of inflation coming down. And instead, I very much agree with Rick that it's ignoring certain indicators that suggest inflation is about to fall. And I have to come to a bad conclusion here, which is that it gives me the sense the Fed is not going to stop until they break something. And I thought they had a chance today. Well, I don't think it's broke.
Didn't SVB count for something?
Well, no, I don't think that.
Three of the four biggest bank failures in history have happened since March, and they consider this not to be breaking anything.
Agreed. We can debate the degree of breakage out there, but I would just say that when I say break something, I mean the economy. I mean really to plunge it into recession. And it seems to me that there's a decent contingent, a hefty contingent of the committee right here that does not want to stop until they really break the back of economic growth here. And I think that's their outlook here, and that's why they're putting 50 more basis points on an economy that seems like it may not need it at this point.
Rick, go ahead and jump in. I saw you shaking your head vigorously.
You know, I completely agree with Steve's assessment there. They are driving forward, looking in the rearview mirror. Not only that, the brakes disconnected, the pedals to the metal on rate increases. I think this move and the hawkishness is purely for messaging. They paused. The pause is the issue we should not ignore. Why would they pause? Kelly's right. Considering everything, why would they pause? Because they want to be done. They just can't share that with the rest of us yet. That's my opinion.
All right, let's go. Greg, you'd like to jump in.
Yeah, Kelly, I think Kelly raised exactly the right question. Given all the data says they should go further, why pause? Let me just read from the statement. Holding the target range steady at this meeting allows the committee to assess additional information and its implications for monetary policy. In other words, we want to see more information. We want to see if that 5 percentage points of cumulative tightening has the effects that we expect to see. I think that, being honest, they haven't seen those effects. I think if you want to be as generous as possible to the case, the thing they worry about most is that the trouble that they had with the banking system a few months ago is not over. We reported this week that they've got their eyes on 30 potentially problem banks. We all three of us have been through these crises before, right? You think it's over, it's not over. And I think there's a large feeling among every member of the committee that they really don't want to tighten into.
Evening all. Hope you guys are doing well. Make sure you smash all the likes on the way in, guys, if you appreciate the stream. We did indeed get a pause here, which I guess is progress, but we're just kind of digesting what the Fed have done just here, which is give us a bit of a backhander at the same time as a compliment, in that they're saying we're still going to do 2 more rate hikes this year, getting some people worried that they're really going to drive the economy into a recession and not stop soon enough to give you that nice smooth landing.
An effect on the economy.
Yes, one last thing, though. But the difference between promising 2 rate hikes and delivering 2 rate hikes is that with the first, you get a little bit of optionality so that at the crisis that you don't think is going to happen, but you're afraid is going to happen, does happen, you can pull back.
Julia, Rick agreed with you there that this is a lot about messaging more than about monetary policy.
Yeah, I have to agree. I think it's important to keep in mind that, a lot of this is how you are thinking about inflation, right? You can say, we've cut inflation in half. But you can also say, historically, getting from 5 to 2% is incredibly difficult. And I think that's what they have in mind. They're terrified to say, mission accomplished, and see all the mistakes that were made in the 1970s. I think that's their primary concern, right? Because credibility has been an issue for these guys. So I think I'm willing to say, trust them when they say they're going to be higher for longer. This is like the credibility that we've assigned to them is like 1999 high school Julie. Like, don't believe her, but do believe them. They're going to stay up here for a while.
Or Michael Kushma, I'll paraphrase our Mike Santoli, who's saying, kind of to Greg's point, is the hold the most important thing here? Yes, they're hawkish in all the messaging, but was that just the cost of getting a unanimous decision on the pause that they ultimately, or the hold that they've ultimately delivered?
I think that's true. They wanted to square the circle and get everyone on board to a policy projection going forward, and this satisfies everyone. People who didn't want to hike rates right now, they didn't get a rate hike, but for the hawks, they didn't promise, but they forecast that they will deliver rate hikes if needed down the road. And what's important is that the economy has not. It's difficult to for the Fed to use their forecast for inflation to run policy, because they tried that for 15 years or so after the global financial.
Okay, guys, so markets are stabilizing here. Bitcoin not overreacting just so much. I think the QQQ, the Nasdaq on the right-hand side, fell a little bit more. Bitcoin sitting here down 0.35. Bitcoin got its own worries, right? And this makes you think that even if we did have a really positive situation, would Bitcoin have really started moving to the upside? It looks like the overhang of the SE stuff is really weighing in on this market. You know, it's sitting there kind of, you know, just stubbornly here at 25,800, can't seem to get above 26.2, which is the resistance, and can't seem to really get past that. If you look here on Bitcoin, we're just forming lower highs, just not looking good, looking really weak. Volumes aren't looking great, and we need some impetus behind Bitcoin. We've got so much overhead resistance now piling up that what's going to be that catalyst for us? Today doesn't look like it's going to be that. I guess the only things that can really give us that push now is obviously getting closer to the halvening, but also starting to get some progress in these SEC judgments, right? Like the Hinman documents and more things around that. Maybe we need more positivity around that. So let's see what questions you guys have, if you have any. Sam says, I'm into Sol at $40. You have to ask yourself, what's your conviction in Sol? Do you like the project? Do you think it's going to recover? Don't fall for the, you know, the sunk cost fallacy, right? Just because you've held it for a long time and you're losing money, all altcoins are down right now. You need to be in the altcoins which you think are going to have the best bull market. That's the key right now. That's what you need to focus on, not sitting on altcoins and being loyal to them. No, it's irrelevant. If everything is down 90%, you want to be in the one that's going to recover back to all-time highs quicker and then has potential to go beyond there. Right, that's the aim of the game right now. So don't fall for the sunk cost fallacy. Cowbunga, I'm late. Was there a hike or pause? Read the ticker below. We did get a pause, but it was a hidden rug pull of a pause where they said we're going to have more rate hikes in the future for this year than the market had previously expected. Matic at $1.20. Somebody said, Sam Design says he's got a Matic at $1.20 cost basis, Saturn at $10. Yeah, look, you're not the only one. There'll be a lot of people with very challenging cost bases. You've just got to work out, you know, which ones do you have conviction in, which ones do you want to double down in, and hold to their next all-time highs, right? That's the key of this market. Nobody invests in crypto. I struggle to believe that anybody invests in crypto without understanding there are horrible bear markets. Everybody knows that. The casual knows that. Your Uber driver will know that. Everybody knows that. But suddenly when those markets come, the 90% market comes, you find out who actually was ready and who actually isn't, right? Because everybody knew about it. If I asked you, do you know in the midst of the bull market when Bitcoin's at 69,000, if I asked everyone, you know there is always a 90% retracement in a bear market. Yeah, it's fine. I'm going to DCA. I'm going to buy some more. I believe in it for long term. But when it actually comes like this and you're there in the middle of it, it's been a year and a half and the Fed are hiking, inflation's out of control and Russia-Ukraine war, and then the SEC is filing this lawsuit. Yeah, this is a bear market. This is how it goes. But so far, the positive news is Bitcoin's always survived. Bitcoin's always gone and shaken everybody out, and off it goes again on a crazy run. You've got to ask yourself, do you have conviction in your plays? And are you DCAing, right? It's all well and good you having a cost basis, buying in the top of a bull market, Bitcoin at 69,000 or whatever your altcoins at, you know, at their highs. But if you can't buy at their lows, there's no point. You're never going to get your cost basis down low enough. You've got to buy and DCA, right? DCA, buy in highs, buy in lows, buy in mids, and if you can, try to buy on red days, right? It's always a nice formula to buy on red days when markets are panicking, when there's a day where the SEC files something, go and nibble a little bit, right? That's the way to build out your positions. Larissa says, will Powell speak? Yes, we will have the Powell press conference shortly, probably in about the next kind of 9-10 minutes or so here for Jerome Powell. We will cover it off along with all the questions. He'll give a pre-prepared statement. Then we're going to look at the questions, and what we want to focus on is, will he come out with anything particularly hawkish? Will he give us any clues for June? You know, we can already see that they've priced in 2 more hikes. You know, does he give us clues around that? What's he thinking? That's what everybody's going to be looking at. Cool?
Could be ahead. Let's get some reaction from David Wessel, Senior Fellow in Economic Studies at the Brookings Institution. Greg Ip is also with us still. And I feel like the only one who's never worked at the Wall Street Journal here. David, let me begin with you. It is unusual, it would seem to me, to have unanimity on the overall decision, but the kind of scatter in terms of the predictions of where the terminal rate may be and how many more interest rate hikes there are likely. Have you seen a Fed like this in your recollection?
Well, first, Tyler, was that your job application for the Wall Street Journal? Would you like to put in a good word?
I'm happy where I am.
That's pretty unusual. I think that often it's said that.
Ian, just reading your comment there, mate, that's all you ever need for advice right there. The trick is believing in it and sticking to it. Absolutely. Absolutely. If you look at all the ways that people build wealth, it's through having an idea, having conviction, and sticking through it for long enough through the ups and downs. Name me one person, you know, apart from somebody who won the lottery, who never keeps their money, by the way, name one person who hasn't done that. A real estate investor believes in property, they buy property, they hold it for many years, through the ups and downs, interest rates go up, they go down, the value of their house goes up, it goes down, but they have conviction in it, and they look back in 10, 15 years' time, they've got a mega wealth of portfolios. Same for stocks, same for dividend portfolios, same for bonds. You buy and you hold. The S&P chart goes up and to the right. Growth continues, right? And same for Bitcoin. If you just hold and invest, the people who cry are the ones that come in, 1 foot in, oh, 1 foot out, it's a scam. 1 foot in, 1 foot out. Go try something else. Oh, I'm going to go try drop shipping now. Oh, look, drop shipping doesn't work. I'm going to try crypto now. Oh, look, crypto doesn't work. I'm going to try another side hustle. That doesn't work either. Just stick with one thing. Navigate through it. Like, spend enough time doing that you become competent in it. But the problem is, everybody sold this dream that, oh, you should be able to become rich in a couple of months. No, absolutely not. It takes time to build wealth. It takes time to build conviction, right? It's not an overnight thing. It's not how it works.
Yeah, I mean, it's just kind of interesting. Like, if you actually go into the internals of the market, and people have pointed this out to me, is that the median stock actually is really well behaved. Like, I think the equal weighted S&P is actually kind of flat for the year, right? So
it's 10 stocks that are 90% of the
NVIDIA
return.
and then a bunch of other stuff, right? So, I mean, if you're a stock analyst, strategist, you say, this market's not carried away, it's just like 8 stocks. To which the Fed's response is, well, yeah, well, NVIDIA's worth $1 trillion, okay? And, like, Intel's only worth, like, 1/10 of that. So I care about the fact that there's $1 trillion of stock market wealth out there that's having an effect on people's propensities to spend, you know? They can't wish away the fact that almost all the contraction in equity values that happened when they first started tightening is gone, right? The financial conditions tightening hasn't been what they expected.
And the multiple for the market undeniably high. Go ahead, David.
I think, look, the real thing they're looking at is that the pace of the economy remains surprisingly strong. The job market is strong. Vacancies have come down, but not a lot. And inflation is coming down, but painfully slowly. So that's a recipe for we need to do more. And I think that's what the message they sent today.
Do they land the plane? Do they land the plane smoothly, David? In other words, avoid a recession? It is a tough one to do.
You know, it's kind of funny. All these recession forecasts keep getting pushed out. First was going to be the first quarter. I still think we're going to have a recession because I think they will do what it takes to get the unemployment rate up to the forecast level. But I agree that there's a better chance than I used to think of a soft landing. I think the thing to watch for in the press conference is if we can tell where Jay Powell is in this spectrum. Is he in the raised rates twice or is he not? I don't know if he'll tell us, but people will be trying to dissect his adverbs and his eyebrow raises to see how hawkish he is.
Very good point there. So obviously, as him being the chair, you want to find out which one of the dots is he, right? You've got 5 dots here which say we want to get up to this range, which is 5 point. So these ones say we can stop where we are. These 4 are saying here that we can have 1 more rate hike, which is what the markets are priced in. So all 6 of these are in favor. Good. Then you've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 people expecting more than 2 hikes or more. Right? These are the ones that we don't want. And we need to find out which one of these dots is Jerome Powell. So we'll see if there's any clues when he speaks.
More nuanced and multidimensional message, right? And therefore, like, you know, people will be able to pluck what they want from that 1 hour of dialogue to sort of make whatever the case.
Guys, for those of you new, I've put a ticker at the bottom, so you just catch up on the ticker. Look, I've put a ticker of exactly what happened, so you don't need to keep asking in the chat. Read the ticker. Come on, look at the production quality, guys.
All right. Thanks, Greg. Thanks, David. Appreciate it.
You're welcome.
Just a couple minutes away from that press conference, we'll hear from Fed Chair Jay Powell himself. He usually speaks for about an hour, taking us inside the decision, the Fed's forecast. He'll explain the projections and maybe how they're looking at the stock market. We'll take you there live as soon as it begins. And there's more of this CNBC special, The Fed Decision, after this break.
All right, so we're nearly close now, guys. Just a couple of minutes, then Jerome Powell, and we're going to find out what do we have in store. Like, is he gonna, the way he's gonna rug the market is becoming across too hawkish. Look, I think the markets have already kind of fallen, and I think we're probably gonna not fall too much, but those are the famous last words. We'll keep these charts open as he's speaking, but market's gonna be listening to see, is he one of those that wants to do 2 rate hikes, or can he try to convince his team to just do 1 and meet in the middle, and then stop for this year, right? That's ultimately where we are at. But we need to understand that the worries the market has is if he keeps going, because you saw how quickly CPI plummeted just now recently, right? So the analogy that the host just used is that they use lagged measures, right? They're driving the car but using the rear view mirror. They're looking over their shoulder to the back. How do you do that, right? You need to know what's coming in front, but that's always been the problem for the Fed. The metrics they use, whether it's CPI, whether it's non-farm payrolls, whether it's PPI, PCE inflation, all of these data points are behind you, right? They are what's happened already. It's not telling you that with a Fed funds rate of 5% for the next month going forward, what's going to happen, right? And that's the challenge. The markets are worried that suddenly they're going to get themselves in a situation where they break something. It's like you put like your branch, right? You're bending a branch, you're bending a branch, you're bending a branch, and you kind of don't know the data. You're looking at, kind of something like a laggy video of it, and then boom, you go too far and it's cracked. And now you're into a recession. Now you're panicking. Now you're scrambling for a pause, but now you're on the back foot. That's not a soft landing. That's you kind of landing on the runway. Boom, you've bounced and you have to go for a go round, right? It's a nightmare. You don't want to do that. You want to land smoothly with a soft landing. That's what the markets are ultimately upset about here.
That they would be done with the cycle already, that they would not be a July hike. The weakness in the U.S. economy is going to start to be registered in the upcoming data fairly soon. Credit contraction is real and it's impacting firms' ability to finance. So I think the Fed will look at that and feel that the job is done and go on hold. They'll continue to keep rates relatively elevated because inflation is going to stick around and probably not get to 2% until at least 2025.
Yeah, ultimately people just make crypto complicated, right? You don't need to make it complicated. It's accessible for the average person, just like every other asset class is. The problem is our societies don't want to teach us in a situation like school or anywhere else how to invest, right? They don't want to. It's far better in their interest for them to teach you whatever's on their agenda to teach you than to teach you the basics of DCAing, investing over a long period, showing you charts. If they taught you this from when you were a kid, that it was second nature for you to understand when markets are panicking, when markets are too joyous, and doing the opposite and learning and how to invest and park money to the side, money you're willing to lose, it becomes second nature for us. But for so many of us, we have to self-learn. We have to come to YouTube channels like this one or any other one and learn how to invest. And it's hard. It's not easy. You have to manage your psychology. And if you're managing psychology as an adult, something you've been taught to be scarce about money, right? There's no abundance of money. It's scarce. Fight for money, guys. Work a wage, right? Then it's hard. But if you open your mind and learn that money is abundant, it's out there. Who's got your money? Go find it. Go learn how to invest. Believe in things growing over time. You plant a seed and it germinates. Then you're going to be all right. But we're not taught to do that. That's why it's so hard. But you've got to do that. You've got to take the onus on yourself. Say, you know what? I'm going to teach myself. And it doesn't matter what asset class you use. It doesn't have to be crypto. And preferably it should be a bunch of them, right? Diversify. Do some real estate. Invest in some stocks. Have a little stock portfolio. Why not? Right? Have a bit of real estate. Invest in a couple of startups if you've got some money. I do that. Right? To start with, invest in your own little business. What a great way to start. And then when that business is making a little bit of money, maybe you take some of those profits, you put it in some stocks, you put it in some bonds, you put it in some commodities. And of course you want to put some crypto in there. Of course you do. Right? But you build and you go over time and you don't panic over these little fluctuations. If you want to trade, that's different. But investing, I'm talking about. Investing. Right, rant over. Z, am I in any trade right now? No, I'm too busy on here. I'd love to trade FOMC day, man. Every single FOMC day when I'm streaming, I don't get to trade it because I'm just sat here doing these streams. So hopefully you guys appreciate it. and at least like support me by using my links in the description or something, so I can make some P as well. Frumoselu, I have to go. Thanks for the live stream. You're welcome. Do pop back later and watch the press conference. I will link it up. I'll timestamp it for you guys so you can go watch it. Ian says, just started my realtor's licensing class today. Good stuff. Diversify. Special cases, invest in yourself first. Yes, I'm going to make more content around this stuff. Like I feel like a lot of you guys want to know this stuff. You know, it's all good me doing technical analysis and crypto. It just happens to be that I like crypto and I like trading. But it's not for everybody, right? And there's different ways to build wealth. I've built wealth through building a SaaS company. I've built wealth through real estate. I've built wealth through many different means, right? You can have equity in a company. I will make videos teaching you guys this, and you need to find the one that suits you and focus on it. But when you do become a little bit more wealthy, start building a portfolio. Crypto should be part of that portfolio, even if it's just a hedge. Put 1% of your portfolio in crypto. If you've got 100K, 1K in crypto, right? Because if it goes wrong, if traditional finance goes wrong and you had nothing in crypto, you're going to be kicking yourself. It's an insurance policy for you guys. Shoaib says, thanks for the live stream. Lloyd says the stream is fine on your side. Okay, good. Shoaib says, smash up the likes. I really appreciate it, but try to stream on the left side and trade on the right side. That way, it's W. Yes. You can't stream like this while streaming. I've got too many buttons to press, and already the computer's overheating, and it's slow, and it's hot, and I've got this fan on. Like, it's such a mess right here. I wish I could just sit here and just trade like the good old days. But again, this is another thing which nobody wants to teach you. They just want to teach you that trading. Trading is like working a job, guys. You spend time and you make money. But as you guys start to make more wealth, as you progress, you want your investments to make you money. Money should make more money, right? That's how it works. So if I'm still sitting here as a trader when I'm 45, I've done something wrong. I trade right now as a hobby. I'm trying to build investments, right? Money should be investing. That's what needs to be happening right now. Trading is a job. If I spend 1 hour trading, I make certain money. That's the definition of a job. I spend time, I make money. It's not an investment. Please don't get it confused. We're going to switch over to Jerome Powell now. Let's go.
Thank you.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. And I will have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer-run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. the labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer-run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25% and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a 0.5 percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. I'm curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated, interest rate sensitive sectors like housing, while they felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were three issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So there was no kind of initial debate about the possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July 2 things. One, decision hasn't been made. 2, I do expect that it will be a live meeting.
Thanks, Howard Schneider with Reuters. I was just wondering if you could help us understand the narrative here, because it feels like there's been a level shift in the dots, stronger GDP, less of a hit to unemployment, slower progress on inflation, and I'm wondering, in this sort of, where's the disinflation coming from?
Sure.
The labor market's going to be stronger, it looks like. It's not coming from there. Demand's not coming down all that fast, according to GDP. You've doubled your estimate of GDP. So what's the narrative here? It seems like it's getting more immaculate rather than more messy.
So you're right that the data came in, I would say, consistent with, but on the high side of expectations. So, and if you go back to the former SEP, the last SEP in March, you will see that growth moved up. These are not huge moves, but growth estimates moved up a bit. Unemployment estimates moved down a bit. Inflation estimates moved up a bit. And, all three of those kind of point in the same direction, which is, that perhaps more restraint will be necessary than we had thought at the last meeting. So although the level, frankly, is pretty. The level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the three-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation to continue to come down over time. In terms of housing services inflation, that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now about inflation coming down this year will contain a big dose of this year and next year will contain a good amount of disinflation from that source, and that's, again, probably going to come slower than we would expect. That leaves, the big sector, which is a little more than half, pardon me, of core PCE inflation. That's non-housing services, and we see only the earliest signs of disinflation there. It's a sector. It's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive, and I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. We have actually seen, I go through a number of indicators suggesting that there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
Nick Timmeros of the Wall Street Journal. Chair Powell, what's the value in pausing and signaling future hikes versus just hiking now? I mean, not to be flippant, but I don't lose weight just by buying a gym membership. I have to actually go to the gym. 16 of your colleagues put down a higher year-end 23 rate today. A majority of you think you're going to have to go up by 50 basis points this year. So why not just rip off the Band-Aid and raise rates today? So
first, I would say that the question of speed is a separate question from the question from that of level. Okay, so. And I think if you look at the SEP, that is our estimate, our individual, it's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting, it's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so the committee thought overall that it was appropriate to moderate the pace, if only slightly. And there are benefits to that. So that gives us more information to make decisions. We may try to make better decisions. I think it allows the economy a little more time to adapt as we make our decisions going forward, and we'll get to see. We don't know the full extent of the consequences of the banking turmoil that we've seen. It would be early to see those, but we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right, and this is if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense.
I know you said July is live with only one June employment, with only the June employment and the.
He just gave it away, guys. Skip. So he's thinking of it as a skip, not a pause. Big difference, right? If you're hiking, you've got a sequence of hikes and you skip one, you're saying I'm going to go back to the normal and carry on, right? He's not saying I'm pausing to look. Interesting, very interesting slip.
On whether this is in fact a skip or a longer pause?
Well, I think you're adding that to the data that we've seen since the last meeting too. Since we chose to maintain rates at this meeting, it'll really be a 3-month period of data that we can look at. And I think that's a full quarter, and I think you can draw more conclusions from that than you can from any 6-week period. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
Thanks for taking our questions. Gina Smiley, New York Times. You obviously, in your forecast, marked up the sort of path for growth, marked down the path for unemployment, marked up the path for inflation pretty notably. I wonder, since March, what has...
It's nice. You can see there on the chart behind me now, NASDAQ is it's now higher than where it was after, just before the announcement. So it's now recovered all that dump to the downside.
Rate, or do you think it's possible we could have even a higher than 5.6% terminal by the end of this cycle?
I mean, on the first part, I just think we're following the data and also the outlook. The economy the labor market, I think, has surprised many, if not all, analysts over the last couple of years with its extraordinary resilience, really. It's just remarkable, and that's really, if you think about it, that's what's driving. It's job creation, it's wages moving up, it's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. So it's really the data. In terms of we always write down at these meetings what we think the appropriate terminal rate will be at the end of this year. That's how we do it. It's based on our own individual assessments of what the most likely path of the economy is. It can actually, in reality, wind up being lower or higher. And there's really no way to know. But it's what people think as of today. And as the data come in, it can move around during the intermeeting period. It could wind up back in the same place. But it really will be data driven. I can't tell you that I ever have a lot of confidence that we can see where the federal funds rate will be that far in advance.
Mr. Chairman, thanks for taking my question. You had said back at the end of May that you thought risks were getting closer to being into balance. Is that still the case, or has your mind changed about the balance of risks out there? And also, could you give us an idea of what would be a sufficiently restrictive funds rate? Obviously, the current rate, according to the committee, is not sufficiently restrictive. Is it 5.6? Is it 6? Where's sufficiently restrictive? Thank you.
I would say again that I think that over time, the balance of risks, as we've moved from from interest rates at effectively 0 now to 5 percentage points with an SEP calling for additional hikes, I think we've moved much closer to our destination, which is that sufficiently restrictive rate. And I think that means, almost by definition, that the risks of sort of overdoing it and underdoing it are getting closer to being in balance. I still think, and my colleagues agree, that the risks to inflation are to the upside still. So we don't think we're there with inflation yet, because we're just looking at the data. And if you look at the full range of inflation data, particularly the core data, you just aren't seeing a lot of progress over the last year. Headline, of course, inflation has come down materially, but as you know, we look at core as a better indicator of where inflation overall is going. So I think what we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see. And I think it's also, we understand that there are lags, but remember that it's more than a year since financial conditions began tightening. I think the reason we're comfortable pausing is that we are still, much of the tightening took place over last summer and later into the year, and I think it's reasonable to think that some of that may come into effect. So we're, I think stretching out into a more moderate pace is appropriate to allow you to make that judgment of sufficiency, with more data over time.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I wanted to ask further on the lag effects. When you're considering when you would hike again throughout the course of the year, are there things that you would expect to kick in as those lag effects come into effect that would inform your decisions? Have you learned things over the past year that give you some sense of timeline for when to expect those lags to come into effect?
Yeah. So it's a challenging thing in economics. It's sort of standard thinking that monetary policy affects economic activity with long and variable lags. Of course, these days, financial conditions begin to tighten well in advance of actual rate hikes. So if you look back when we were lifting off, we started talking about lifting off. By the time we had lifted off, the 2-year, which is a pretty good estimate of where policy is going, had gone from 20 basis points to 200 basis points. So in that sense, tightening happens much sooner than it used to in a world where news was in newspapers and not on the wire. So that's different, but it's still the case that what you see is interest-sensitive spending is affected very, very quickly. So housing and durable goods and things like that. But broader demand and spending and asset values and things like that, they just take longer. And you can pretty much find research to support whatever answer you would like on that. So there's not any certainty or agreement in the profession on how long it takes. So, and that makes it challenging, of course. So we're looking at the calendar, we're looking at what's happening in the economy, we're having to make these judgments. And again, it's one of the main reasons why it makes sense to go at a slightly more moderate pace now as we seek that ultimate. I can't point to that ultimate endpoint. I can't point to a specific data point. I think we'll see it when we see inflation, really flattening out reliably and then starting to soften. I think we'll know that it's working. And ideally, by taking a little more time, we won't go well past the level where we need to go.
I was curious if you could give us an update on what you're seeing on credit tightening since the bank incidents from March and how you're teasing that out apart from these lag effects.
So it's too early still to try to assess the full extent of what that might mean. And that's something we're going to be watching, of course. And if we were to see what we would view as significant tightening beyond what would normally be expected because of this channel, then we would factor that into account in making rate decisions. So that's how we think about it.
Let's go to Chris.
Thanks. Chris Rugaber at Associated Press. You mentioned that many of the trends are in place that you want to see. Core services ex housing has come in pretty low in the past couple of months. And as you noted, a significant portion of core inflation is now housing prices. And then we've had some quirks in used car prices. So given that these trends are in place, I guess I'm sort of asking the flip side of Nick's question, why signal additional rate hikes? Aren't things headed in the direction you need? Why not simply give it even more time? Or it's surprising to see so much hawkishness in the dots given what we're seeing recently.
Yeah, so we've we're 2.5 years into this, or 2.25 years into this, and forecasters, including Fed forecasters, have consistently thought that inflation was about to turn down, and typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level over 4.5%, far above our target, and not really, moving down. We want to see it moving down decisively. That's all. Of course, we are going to get inflation down to 2% over time. We don't want to do. We want to do that with the minimum damage we can to the economy, of course. But we have to get inflation down to 2%, and we will. And we just don't see that yet. So, hence you see today's policy decision, both to write down further rate hikes by the end of this year, but also to moderate somewhat the pace with which we're moving.
Quick follow-up. I mean, at the last press conference, you mentioned you didn't see wages driving inflation, and there was some research from the San Francisco Fed suggesting wages aren't necessarily a key driver. But you've talked about the labor market today and the need for softening. Can you give us a little more specifically of how you see the tight labor market driving inflation at this point? Thank you.
Right. So I'm not going to comment on any particular paper, but
So this is a question about wage price spiral.
Sure is that at the beginning, in early 2021, inflation was really coming from very strong demand largely for goods. People were still at home. They had money in the bank and they wanted to spend, and they spent a lot on goods. And of course, at the same time, and because of that high demand to some extent, supply chains got all snarled up. So prices went way up, inflation went way up. That was the origin, and it wasn't really particularly about the labor market or wages. But as you move through 21 into 22 and now in 23, I think many analysts believe that it will be important, an important part of getting inflation down, especially in the non-housing services sector, to getting wage inflation back to a level that is sustainable, that is consistent with 2% inflation. We actually have seen wages broadly move down, but just at a quite gradual pace. So, and that's a little bit of the finding of the Bernanke paper with Blanchard of a few weeks ago, which is very consistent with what I would think.
Michael McKee from Bloomberg Radio and Television. You said in the past that you don't like to surprise markets. It's kind of been the Fed's view. Markets should have an idea of what you're going to do before you go in. You also said a number of times that it would take a while to bring inflation down. You reiterated that again today, and that we would get to a point where inflation could be sticky. So I'm wondering, as we go into the next meetings, how Wall Street or others should look at your reaction function. What will you be reacting to? Time or data? In other words, if nothing much changes, if we're looking at the same sort of labor market, the same sort of inflation levels in July or in September or November, will you move because you've said you feel you need to? Is it time that's going to require additional movement, or would it be a reversal in inflation?
So I don't want to deal with hypotheticals about different ways data might move on. So we of course we don't go out of our way to surprise markets or the public. At the same time, our main focus has to be on getting the policy right, and that's what we're doing here, and that's what we'll do for the upcoming meetings. I will say the July meeting will be live, and we'll just have to see. I think you'll see the data, you'll hear Fed people talking about it, and markets will have to make a judgment.
Well, do you think inflation is likely to continue coming down based on the lags and based on your threat of additional movement, or are we going to be in a period where we're not going to know what's happening?
I think if you look at if you just look at, I'll just point you to the forecast. So inflation is running, core PCE inflation is running at about 4.5%, a little higher than 4.5%, and the median FOMC participant thinks it'll go down to 3.9 on a 12-month basis. This is by the end of this year. So that's expecting pretty substantial progress. That's a pretty significant decline for half a year. So that's the forecast. We do try to be transparent in our reaction function. We're committed to getting inflation down, and that's the number one thing. So that's how I think about it.
Let's go to Victoria. Victoria Guido with Politico. Could you talk about the balance sheet and how you're thinking about it? What are you looking for to judge whether we're approaching reserve scarcity, and is Treasury issuance going to affect that? Also, are you considering lowering the RRP rate in order to take some pressure off banks?
So let me say, first of all, on the Treasury part of it, if I can talk about that, and then go back to the balance sheet. So on that, of course, we've been very focused on that for a couple of months, as everyone has. Treasury has laid out its borrowing plans publicly. I think I saw the Secretary's comments yesterday to the effect that Treasury has consulted widely with market participants about how to avoid market disruption, and that they're going to watch carefully for that. So that's from the Treasury, which actually sets the borrowings. At the Fed, we'll be monitoring market conditions carefully as the Treasury refills the TGA. The adjustment process is very likely to involve both a reduction in the RRP facility and also in reserves. It's really hard to say at the beginning of this which will be greater. We are starting at a very high level of reserves and still elevated over RRP to take up, for that matter. So we don't think reserves are likely to become scarce in the near term or even over the course of the year. So that's That's the Treasury part of the answer. We will, of course, continue to monitor conditions in money markets, and we're prepared to make adjustments to make sure that monetary policy transmission works. Was there another part of your question?
Yeah. What are you considering lowering the RRP rate to help take some pressure off banks?
So we have a number of. I would say the RRP doesn't look like it's pulling money out of the banking system. It's actually been shrinking here lately. So I don't think that's not something we've thought about a lot over time. It doesn't really look like that's something that we would do. I think it's.
The RRPs are reverse repos, okay? So another way of kind of giving the government money. It takes liquidity out of the market, which is what we don't want. That's what she's asking.
In the near term.
Janelle Marte with Bloomberg. Have you seen sufficient cooling in the housing market to bring inflation down? For example, how does the recent rebound affect your forecast, and how does it factor into monetary policy?
So certainly housing, very interest sensitive, and it's the first place really, or one of the first places that's either helped by low rates or that is held back by higher rates. And we certainly saw that over the course of the last year. We now see housing putting in a bottom and maybe even moving up a little bit. We're watching that situation carefully. I do think we will see rents and house prices filtering into housing services inflation, and I don't see them coming up quickly. I do see them kind of wandering around at a relatively low level now, and that's appropriate.
Do you think you'll have to target that with further rate increases?
Well, I think we look at everything. We don't just look at housing. So I think, the way it works is individual participants sit in their offices all over the country and they write down their forecast, and including their most likely forecast, including their rate forecast, and then they send it in on Friday afternoon, and we accumulate it, and then we publish it for you. So that's how they do that. Well, I don't know that housing is itself going to be driving the rates picture, but it's part of it.
Thank you for taking the question, Mr. Chairman. Edward Lawrence with Fox Business. So I want to go back to comments you made about in the past about unsustainable fiscal path. The CBO projects the federal deficit to be $2.8 trillion in 10 years. The CBO also says that federal debt will be $52 trillion by 2033. At what point do you talk more firmly with lawmakers about fiscal responsibility? Because I'm assuming monetary policy cannot handle alone the inflation or keep that inflation in check with the higher level of spending.
I don't do that. That's really not my job. We hope and expect that other policymakers will respect our independence on monetary policy, and we don't see ourselves as the judges of appropriate fiscal policy. I will say, and many of my predecessors have said, that we are on an unsustainable fiscal path, and that needs to be addressed over time. But I think trying to get into that with lawmakers would be kind of inappropriate, given our independence and our need to stick to our knitting.
Is there any conversation then about the Federal Reserve financing some of that debt that we're seeing coming down the pike?
No, under no circumstances.
Thanks for taking our questions, Chair Powell. So looking at the SEP, it looks like GDP for this year was raised significantly, your forecast for GDP this year. The unemployment rate, meanwhile, was pulled downward. And so should we take that as a sign that the committee is more confident about the prospects of a soft landing, at least as it relates to what you were expecting in March?
I would just say it this way, that I continue to think, and this really hasn't changed, that there is a path to getting inflation back down to 2% without having to see the kind of sharp downturn and large losses of employment that we've seen in so many past instances. It's possible. In a way, a strong labor market that gradually cools could aid that along. It could aid that along. But I guess I want to come back to the main thing, which is, though, simply this. We we see the committee, as you can see from the SEP, the committee is completely unified in the need to get inflation down to 2%, and we'll do whatever it takes to get it down to 2% over time. That is our plan. And, you know, we understand that allowing inflation to get entrenched in the U.S. economy is the thing that we cannot allow to happen for the benefit of today's workers and families and businesses, but also for the future. Getting price stability back and restored will benefit generations of people as long as it's sustained, and it really is the bedrock of the economy, and you should understand that that is our top priority.
Like, you may not like it, but he's doing the right thing, right? He's saying more pain now for less later. He's referring specifically to the Volcker period, where he just accepted that 4 or 5% inflation would be entrenched, and it stayed like that for a very long time. And once you let it become entrenched, it doesn't go away.
Can you help me understand that?
Sure. So, you know, if you look 2 and 3 years out with the forecast, first of all, I wouldn't put too much weight on forecasts even 1 year out, because they're so highly uncertain. But what they're showing is that as inflation comes down in the forecast, if you don't lower interest rates, then real rates are actually going up, right? So just to maintain a real rate, the nominal rate at that point 2 years out, let's say, should come down just to maintain real rates. And actually, you know, since we're probably going to we're having real rates that are going to have to be meaningfully positive and significantly so for us to get inflation down. That probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate. If you think about it, inflation has not really moved down. It is not so far reacted much to our existing rate hikes, and so we're going to have to keep at it.
Very interesting. He means business. He means business.
Hi, Chair Powell. Julie Chabanas, AFP News Agency. The May job report showed a rebound in May in black workers' unemployment. Is it consistent with the Fed's maximum employment mandate? Are you worried about that, about this rebound?
So we are, of course, worried about there are long-standing differences in racial and ethnic groups across our labor market. That's a factor that we can't really address with our tools, but we do consider that when we're thinking about what constitutes maximum employment. It is for us a broad and inclusive goal, and so we do watch that. But remember, all unemployment, including black unemployment, has been bouncing around right near historic lows, historic modern lows here. So we're still talking about, I mean, what is as strong a labor market as we've seen in, you know, a half century here in the United States. So overall unemployment of 3.7% is 0.3 higher than it was measured to be at the last a month ago, but still it's extraordinarily low. And so it's a very, very tight labor market.
Thank you. I want to follow up first a little bit just on the rent question on housing. We heard Governor Waller talk about how, I'll back up, we haven't quite seen the slowdown in rents show up in CPI yet, and we did hear Governor Waller talk about how an uptick in housing might mean that there's not going to be as much relief coming, or a shorter bit of relief than we thought. Can you talk about how you're thinking about that and how that played into today's outcome?
I wouldn't say, so that's, you know, as a factual matter, that's correct. We do need to see, you know, rents bottom out here, or at least stay quite low in terms of their increases, because we want the you know, we want inflation to come down, and rental is a very large part of the CPI, about a third, and it's about half of that for the PCE. So it's important, and so it's something that we're watching very carefully. It's part of the overall picture. I wouldn't say it's the decisive part, but take a step back. What you see is look at core inflation over the past 6 months, a year. You're just not seeing a lot of progress, not the kind of progress we want to see, and it's hard to avoid that. And you know, people in the committee, the median went up significantly so that the median participant now thinks that core PCE inflation on a 12-month basis will be 3.9% this year. So once again, every year for the past 3 years, it's gone up over the course of the year, and it's doing that again. So we see that, and we see that inflation forecasts are coming in low again, and we see that tells us that we need to do more. And so that's why you see the SEP with where it is.
Could you also talk briefly about your outlook for wages, and given the recent slowdown in core services excluding housing, how far you think wages might need to fall in order to get inflation back in line?
So wages will continue to increase. So what we're talking about is having wage increases still at a very strong level, but at a level that's consistent with 2% inflation over time. And so I think we've seen some progress. All of the major measures of wages have moved down from extremely elevated, not extremely, but highly elevated levels a year or so ago, and they're moving back down, but quite gradually. And we would want to see that process continue gradually. Of course, it's great to see wage increases, particularly for people at the lower end of the income spectrum. But we want that as part of the process of getting inflation back down to 2%, which benefits everyone. I mean, inflation hurts those same people more than anyone else. People on a fixed income are hurt the worst and the fastest by high inflation.
Thank you so much, Chair Powell. Greg Robb from MarketWatch. I just wondered if the committee has talked at all about the labor market, and there's strikes now in Hollywood, and now the United Auto Workers are talking about a possible strike. I mean, aren't workers, some workers have power now and are going to be seeking higher wages. Does that come up in your discussions? Thanks.
So the topic of wages in the labor market and dynamics in the labor market is about as central a topic to our discussions as anything. I mean, it's very labor economics, and the labor market are utterly central. It's half of our mandate. So we spend a lot of time talking about that. I think, there are structural issues that are really not for the Fed. And so we don't spend a lot of time, although we take notice of what's going on. But we're not involved in discussions or debates over strikes and things like that. But we look and we see what's going on, and we're making judgments about what it will take to get inflation down to 2% in the aggregate. And as I said, don't think that was about. Most folks would say now it wasn't really about wages at the beginning. And it's becoming more about that as we get into really service sector inflation, which is the part of the economy where we have seen the least progress.
Let's go to Mark for the last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. Wondering what your thoughts are now about systemic risk now that we're about 3 months past the failure of Silicon Valley Bank, and also specifically, what are the risks associated with commercial real estate as well as non-bank financials, and could you further elevate those risks with higher still rates, possibly for longer?
So we're trying to think where to start. I'll start with commercial real estate. We, of course, we're watching that situation very carefully. There's a substantial amount of commercial real estate in the banking system. A large part of it is in smaller banks. It's well distributed. To the extent it's well distributed, then the system could take losses. We do expect that there'll be losses, but there'll be banks that have concentrations, and those banks will experience larger losses. So we're well aware of that. We're monitoring it carefully. It feels like something that will be around for some time, as opposed to something that will suddenly hit and work its way into systemic risk. In terms of non-bank financial sector, there's been a ton of work, and clearly in the pandemic, it really was the non-bank financial sector where issues really arose, and there's a lot of work going on with the administration, in particular, leading that to try to address issues in the Treasury market and in all kinds of areas in the non-bank financial market. But our jurisdiction at the Fed is over banks, actually bank holding companies and some banks. So that's really our main focus. In terms of the events of March, as I mentioned earlier, we will be carefully monitoring that situation. You know, our job generally involves worrying about a lot of things that may go wrong, and that would include the banks. It might be hard for me to identify something that we don't worry about rather than that we do worry about. So we're watching those things very carefully. And as we see things unfold, as we see what's happening with credit conditions and also all the individual banks that are out there, you know, we'll be able to take, to the extent it's appropriate, we can take, if there are macroeconomic implications, we can take that into account in our rate setting. And so I guess that's what I would say.
Can I just follow up on the last part? That's, do you risk further exacerbating those issues if you get up to another 50 basis points?
So that's, and I guess I meant to address that by saying, as we watch, we'll see what's happening, and if we're seeing the kind of tightening of conditions that you could be referring to, then we can factor that, because really we use our rate tool it really has macroeconomic purposes, so we'll take that into account. Of course, we have responsibility for financial stability as well, and that also is a factor that we're always going to be considering. Thank you very much.
All right, that made me sleepy, guys. So we've got our pause, right? All that to say, we've got our pause, but it was a bit of a hidden rug. I'm going to explain. I'm going to do a summary video for you guys. There were some key messages that he did share there, which we need to make sure we understand. But overall, if we take a look here at the charts, Bitcoin is fairly unchanged, right? We're sitting here at 25,800. It was a nothing burger. You can see the NASDAQ sitting here. Yes, the traders are playing their games and moving the market, but the market's going to have to now digest this. So make sure you tune back later on. I will do like a quick 7-8 minute video update, just summarizing everything so you've got it there in one neat place if you weren't able to listen to all of that in one go. Thank you for joining the live stream. Don't forget to smash the likes. Don't forget to subscribe. And I'll see you in the